Howdy, Team 42. It's your skipper here, Darius Dell, to present our Pro Live episode for Wednesday, June 2024. I'm joined by our friend Kris Sidial from Ambrus Group, as the co-CIO over there. Kris is a repeat guest on our program, but for those of you who may not be familiar with Kris or what they're doing over there at Ambrus Group, Kris, can you walk us through your background and kind of how you guys are helping clients?
Yeah, for sure. First and foremost, thanks again for having me back, man. As I was saying, I love this energy, chopping it up with you. So it's always a fun discussion.
Thank
Uh,
you.
but yeah, so I actually started out under a vol veteran individual by the name of Bob Kanter, who was on the CBOE back in the day and ran ETG in the 90s and 2000s. So that's how I started to learn how to trade vol. And then I went to trade as a proprietary trader at Chimera Securities and Xanthus Capital. And then from there, I went to a Canadian investment bank, spent 3.5 years there. Most of my time there was trading exotic derivatives. And then March 2020 came, and myself and a couple of my partners who are ex-CTC, ex-Citadel guys, we looked at the environment and we said, there's not too many people that know how to run an effective tail risk book. Like when you think about tail risk hedging, investors get very turned off because you just bleed money year over year and lose money consistently, right? Which is not really the best thing for investing. So we said, we have the expertise on the prop trading side and the expertise on the derivative side, and we could put together a carry neutral tail risk hedge, right? Which effectively could be looked at in a binary way where you say, hey, if vol is going up a lot, we're going to have this really large return. Equity vol going up a lot, right? We'll have this really large return. But if there is no equity vol, we use a lot of short-term proprietary trading that really involves these statistical edges to offset the bleed, right? So in a binary way, if there is no vol, we're trying to be flat. If there is vol, we're trying to have this really, really big return, right? And that's served as a better tail risk product for institutions, family offices, high net worth investors. Um, and yeah, I mean, we've been running Ambrus for about 4 years now, and it's been pretty good. So that's that's the background.
Well, pretty good in the context of a raging bull market has been is actually quite awesome. I would imagine you guys' performance is top decile with respect to your peer group in terms of assets. And so, just want to congratulate you on that. You said something that piqued my interest because you guys sort of live in the Darth Vader. What's that called? What's the big fortress called? From Star Wars, you guys kind of live in that side of finance. When you start to layer on the Greeks, and so. You mentioned something. You guys are trading statistical edges, which gives you guys an edge over your competitors in terms of not bleeding consistently and aggressively throughout, kind of bull market periods. Give me an example of a type of trade you would take advantage of one of those statistical edges, if you can share. Don't share anything.
Yeah. So what I
Yeah.
so what I would say is that in this environment, when you think about this environment, there have been more price insensitive end users that have ever participated in markets, right? And it's not, people think that it's just, oh, retail participants that come in and aggressively buy options or buy stocks. But it's not just that. You have a lot of passive flows, right? You have ETF rebalancing. You have force flows that need to buy at certain times of the day, that need to participate in certain names. And what this has opened up is really a big avenue for a lot of intraday trades that
Mhm.
take place where you have the best of both worlds, right? One, you don't need to take large amounts of risk and overnight risk, but then also when you have price insensitive end users, it opens up the opportunity for alpha, right? Like when you have another participant that says, hey, I don't care what the price of this option is or the price of this stock, like I just need to buy it right now, right? That opens up a lot of avenues for alpha. So it's been a great environment for us in terms of being able to use those statistical edges that present themselves and have existed for decades, right? We have known and traded derivations of these edges for well over 10 years, but this environment is really lucrative with them. So that's what I would say, is that you have forced buyers and sellers that participate intraday and in a slew of different products, in single name stocks and in single name stock derivatives and whatnot. So the opportunity set is pretty wide.
Yeah, that's really interesting you say that. So it's effectively taking advantage of flows that you know are predictable and consistent. I would imagine structured products being on one of those categories of flows. You also have these kind of birth of over the past few years with our friends, guys like Simplified. You have the birth of this sort of ETF plus asset class with active managed ETFs with options and options overlays within those ETFs. And I would imagine some of those flows are starting to become quite predictable and gameable as well for firms like yours. Is that the case as well?
Yeah, absolutely. And that's not specifically speaking for Simplify. We're just
No,
talking
no.
about, we're just specifically talking
Yeah,
about,
man.
ETF flows and just flows that persist intraday, right? So you have like market makers and the way how they hedge off their gamma exposure. You have ETF rebalancing. You have the democratization of finance with everybody being able to just go on their phone and click buy or sell. So that passage of news that then flows into price discovery, there's like a linkage that takes place there. And when you have these type of price insensitive flows where buyers and sellers just don't care, right? And they're coming from five different sources. Uh, these type of intraday trades, they open up in a quite lucrative manner.
Yeah. Well, I appreciate you sharing all that, man. And like I said, for those of you who are obviously we've been in this raging bull market. If you are concerned at all about your capital and ability and ability to access liquidity, if we were to head into a market downturn, a severe market downturn, then to certainly check out Kris and what they're doing over at Ambrus Group. What's your Twitter handle, Kris?
It's KSIDII or I. I think it's like three I's, but you guys could just Google Kris Sidial or go on the ambrusgroup.com. We have stuff there that talks about what we do as a carry neutral tail risk hedge.
Awesome, awesome. And you guys put out some of the best white papers in the industry, by the way. Obviously Chris Cole had the crown of vol product and vol asset class white papers, but I would argue over the past few years, you guys have kind of wrestled that crown away from him. I've learned a tremendous amount reading a lot of your white papers about the derivatives markets and how they've evolved over time. So definitely check out that. I know you guys have a spot on your website where you house all your research and publications.
Thank you so much for that, by the way. That's really humbling because we put a lot of work into that stuff. So it's always good to get positive feedback on the research stuff that we put out.
Totally. Likewise, man. So let's hop into the fun part of the discussion, which is where we are in economic and market terms and where we're likely headed. I'll start by kind of giving you an opportunity to identify your kind of 30,000-foot view of the world. What's your general world view right now? Bullish, bearish, what's causing that, et cetera.
Yeah, so I'll talk a little bit about the volatility landscape, because I think that viewers will probably get the best value here. You're the macro expert. Right?
Fair enough.
So, so
Although I will say, before you even go there, I would argue you're also a macro expert as well. Like I've listened to your macro views for years, and I don't know if you're doing the same level of a deep dive analysis and econometric analysis, but you certainly have a good ability to pull together a lot of research and a lot of sources and form a cogent, coherent investment thesis. And so, congratulations on that.
yeah, that's much appreciated. I think the macro views that I have are just more so for internal because the
Yeah.
way how we operate, we don't really trade on macro views. It's just a strict process, right? It's doing the same process over and over.
Ironically, neither do we.
Yeah.
Neither do we.
So I've had certain views in the macro term, but it never really affects what we do from a trading standpoint. But neither here nor there. On the derivative side, it is a very interesting environment that we've been noticing. So for the last 7 months, I've been quite outspoken about this short volatility trade. I went on the Odd Lots podcast and I had this whole thing, and a bunch of people have interviewed me from like all the journalists and stuff like that. And now I think a lot of people are labeling me as a guy who's saying, the short volatility trade is gonna blow up, right? Which is not anything abnormal, right? Because when you look at vol historically, you could go back and you could realize that vol moves in these type of behavioral cycles, and every few years equity vol makes a move higher, right? So you could think back from 96 to 97 to 2001, 2008, 2010, 2011, 2015, 2018, 2020. Those are all notable years where VIX went over 40, right? And one thing to note is that, well, it, the cycle that takes place, it takes place every, let's call it 4 to 5 years or so, right? So where we are right now in the cycle um, is really at that point where you're starting to see the overcrowding in that short volatility trade. And it's not really because of now obviously you do need a catalyst to drive that trade through, but that's
Quickly
not.
before we
Mhm.
go, for those who may not be familiar with kind of the short volatility trade, what do you mean by that? Because that's kind of a big phrase.
Yeah, absolutely. So when you think about the short volatility trade, it's different forms of selling volatility to profit, right? So this comes in a yield form, so you could sell options. That's like really the number one way to express a short volatility trade. So the same way how you may buy a call on the VIX because you believe volatility is going to go higher, you could also sell a call on the VIX, right? Or you could sell S&P put.
Yep.
um so yeah, I mean, over the last few years, what we have noticed is the short volatility trade has been growing, and it's really because of a natural inclination that these yield seekers have. And when I mean yield seekers, is you've had a slew of the advisory community, so the RIA community, that have gravitated over towards different forms of smart yield, right? So people want to sell a little bit of zero DTE options, a little bit of 1 week options, a little bit of 1 month options, maybe sell some 3 month options, and really try to diversify that exposure. But ultimately, what ends up happening is that exposure ends up taking on correlation risk, right? Because
Oh, yeah.
in a world where VIX is at 12, you're selling optionality and you're selling volatility versus a world where VIX is at 40. All of those type of positions are going to be underwater, right? So that's the first thing. You've had that natural inclination of yield seekers. uh, we talked about the structured products, and I want to try to make this as simple as possible, so I won't go into like extreme details. But the structured products community has been growing, right? There's been more new issuances of these structured products, which has led to the dealers naturally selling vol on the index side. And what we've noticed in the vol community is that the dealer community, instead of selling a tenor neutral, which means if they issue a 6 or let's say a 1 year note, they sell vol on the index side for 1 year. Instead
Right.
of them doing that, what they're doing is they're gravitating over towards shorter stuff. So they'll sell 3 to 4 3 month stuff, right? And then keep rolling that to net and net make out a profit on selling vol, and then also keeping that note that they have issued out there.
Is that because the curve is inverted? The slope, because of the slope of the curve?
Not really. I think it's just because how the path dependency changes when you
Gotcha.
have these shorter dated options. So I think that has attracted the dealer community, and that's why you're seeing. It's actually one of the reasons why you've seen that curve slope down, right?
Yeah.
Because like the front of the term structure is getting caved in as people sell vol.
Yeah.
Uh, the other thing, here's the hot word for in the vol community, is the dispersion trade, right? Like um, CBOE has put out this index, the dispersion index. Dispersion trading has been popular, extremely popular for the last 2 years. You have a bunch of these QIS programs at these banks that are packaging these dispersion packages and really shopping them off to certain macro desks. And ultimately, what dispersion looks like is you sell index vol and then you buy vol in the constituents of the index, right? So just for let's use an easy example. Let's say hypothetically the S&P was made up of Apple, Amazon, and Tesla, right? What you would do is you would sell S&P vol and then buy vol on Apple, Amazon, Tesla, right? That's
Mhm.
that's like the dispersion trade. So ultimately, what that means is when you sell S&P vol, you're driving index vol lower and lower, right? So you're naturally taking this type of short vol on the index standpoint side type of trade. So
How
that's
does
the
that trade make money?
what's that?
How does the dispersion trade make money?
Well, when the constituencies start to outperform, the vol outperforms. So, like, let's say if index vol doesn't go anywhere, but then Apple vol, Amazon vol, and Tesla vol actually move. you make money between that spread. Right.
Gotcha.
And it doesn't necessarily need to be downside too, right? If Apple upside vol, goes up a lot, you could make money on that. So
Gotcha.
that's really the flavor as to why and then also just short volatility hedge fund AUM growth, right? So let's just think about the behavioral dynamics that take place in markets. When something is working, people like to invest in it, right? They love doing that. They love that chasing mentality. So um, because short volatility has worked so well for the last 4 years, if you look at the AUM growth in these short volatility hedge funds or yield programs, they've increased ginormously, right? So think about this, right? Think about JP Morgan private wealth program, who may have some type of yield enhancement vol selling program, and I'm like laying the land here, so it's not exact numbers, but in 2020, if the AUM in that program was, let's call it roughly 25 million, today the AUM in those programs are sitting north of 400 million,
Mhm.
right? And that's just one program at one of these private wealth places. So that's another big thing. And then when you think about that, well, instead of them selling vol to match a 25 million book, now they have to do it on a 400 million book, right? So, right, it's sort of like the flows thing, right? If you have a fund that buys the S&P and they're $1 billion, and now they've ballooned into $100 billion, right? There's more flow that they're going to have to be mandated to buy. So
Of course.
so naturally, that short volatility trade has become quite crowded in the market, which makes it an interesting time for like long vol or tail risk funds, right? Because or tail risk traders, because the opportunity set is there, but if you're just dogmatically buying volatility, that doesn't work, right? Because as we noticed in a year like 2017, this could go on for a year and a half, right? Or it could go on for another 2 years or so. But environmentally, it does feel like we're almost at that point where any type of small catalyst could get vol to react a little more strongly than what we've noticed over the last few years.
Yeah, I don't disagree with that. We've been bullish and we remain bullish, but when you think about this from a, sort of a longer term time horizon in our context, which is anything over a year for risk management terms, we are not in a good spot in the positioning cycle to expect, the persistency of short ball type exposures to work, over 1 year plus time horizon. Colin, if you throw up slide 18 here on the screen where we show our positioning model. So those who may not have seen this before, what we're doing in this position model, we're tracking, I want to say 12 or 13 different indices, some proprietary in terms of where they are relative to their historical time series. And then what we do is identify, okay, where is the indicator at major bull market peaks and major bull market troughs? Where were they on a 25th percentile basis, median and 75th percentile basis, so that we can understand, hey, is the current value of the indicator consistent with a major bull market peak or a major bull market trough? And when you look at the indicators, particularly the indicators on the right side of the chart that are more sort of correlated to the medium to long-term time horizon, which in our nomenclature is 3 to 12 months or anything beyond the year, 6 of those 7 indicators that correspond to the equity market, specifically the AII stock allocation, the AI bond allocation, the AI cash allocation survey, the realized volatility, which we use as inverse proxy to systematic fund exposure, implied vol correlations, which we use as inverse proxy to market neutral hedge fund gross exposure, and then the S&P 500's valuation. 6 of those 7 indicators are flashing red, i.e., they've breached the historical threshold that they've observed at these major bull market peaks in the S&P 500. That today is a major bull market peak in the S&P 500. It just means that from a positioning cycle standpoint, you don't need a lot to go wrong to create negative outcomes on a multi-quarter basis in the stock market. And so, I definitely agree with you that this is the time to be thinking about long vol exposure. A lot of times folks, tend to chase. So if they'll see the VIX spike to 40 or even 80 back in 2020, that's when they think, okay, now I need to have long vol exposure in my portfolio. But in our opinion, if you're doing your proper due diligence in terms of trying to identify where you potentially are in the market cycle, in the liquidity cycle, and obviously in this case in the positioning cycle, then I think it'll give you a better opportunity to kind of put that kind of exposure into your portfolio in a way that allow you to actually make money.
Yeah, absolutely. I mean, That's another thing in terms of like the behavioral dynamics as to how things work, right? It's you always get those investors that become very interested with a certain product type after the event has taken place or while the event's in motion, right? As opposed to looking at the opportunity set previously. So 2022, at the end of 2022, I found this very fascinating on the CTA space because every investor in the world wanted to get into CTAs at the end of 2022. But during 2021, everybody knew, the Fed was looking to hike rates and they knew inflation was here. Like nobody thought to get into CTAs during that. You look at CTA inflow in 2021, it was like nothing compared to the end of 2022. So it is fascinating to watch that behavioral dynamic always take place, and not only in equity vol or tail risk hedging or anything like that, but in every asset class. Bitcoin was another thing too. Remember, like so many inflows came into Bitcoin directly at the top. It's yeah,
Yeah.
yeah.
And and you're kind of hitting on something that I think we don't talk about enough as financial market participants, which is the pervasiveness of momentum as a dominant force in asset markets. Flows chase performance, whether you're talking about institutional AUM or if you're watching home as a retail investor, your own portfolio tends to reflect what is going up as opposed to what is going down. People chase performance as a natural, their behavioral cognitive biases that cause us to do that. And so one of the things that we've done over the past few years is increasingly orient our investment process around taking advantage of momentum in asset markets, and more importantly, I would say, just as importantly, as taking advantage of spotting critical inflections in momentum in real time. Colin, if you throw up this slide here, where we show our back test for our volatility adjusted momentum signal for the stock market and for crypto market, what we find is that again, momentum is this incredibly powerful force for asset markets. 76% of the S&P 500's return since the beginning of 1998 has come when the S&P 500 is in a bullish VAMS condition, i.e., it's bullish according to our volatility adjusted momentum signal. That compares to only 8% when it's neutral and 16% when it's bearish and coming off the lows of a crash. If you that momentum signal is actually even more exaggerated when you look at something like the crypto market. 98% of Bitcoin's positive performance since the inception of the asset class has come when it has had a bullish VAMS condition, i.e., our volatility adjusted momentum signal was saying that Bitcoin is bullish as it is currently today. Only 5% of the Bitcoin's performance has come when it's neutral, and minus 3% has come when it's bearish. And so, understanding this, just back tested reality and understanding that, okay, we've spent all this time talking about liquidity and flows and plumbing and growth and inflation. But at the end of the day, the most important factor in asset markets and the factor that is most correlated to whether you make money or lose money is momentum. And so going back to this discussion, how do we, what are some of the things that you guys are doing either in your marketing materials, in your education, and or in your strategy to sort of kind of help you guys grow with the understanding that hey, folks are going to chase, so they're probably not going to flow funds into your segment of the asset markets until after something bad has happened. Obviously, your goal is to get them to do that before something bad happens, so you can actually do something positive for their portfolios.
Yeah, I think internally as a team, a lot of the way how the business is structured is focuses on our own trading, right? Which is something that has supported the business since inception. So as much as it is a focus of trying to spread the message about long ball and tail risk hedging and the importance of that, we don't necessarily need to do it in an urgent way. And we also know that we've moved with the mentality that uh, at the end of the day, people are going to look at and see the difference in the returns, right? So over the last 4 years, if you take a look at our returns and then also compare it against some of these tail risk solutions or tail risk products or things like that, there's a like it's day and night, and that's sort of what we take a lot of pride in is that, well, you guys are gonna we could sit here and we could tell you, oh, this is the greatest thing since sliced bread, or you could just kind of look at it for yourself, right? And you make that judgment call, because ultimately, you're not going to convince people in terms of like tail risk hedging or long volatility. It's like something that they themselves are going to have the light bulb on. So we could educate, but we can't convince, right? Like that's ultimately how it is. But I think as a firm, we've been quite happy with the investor base that we have, and then also the type of investors, like the type of investors that gravitate over towards us are the like sophisticated vol investors. So we have like prop firms that will allocate to us. We have guys that have been ex prop traders and things of that sort, because I think they look at the world and they understand that, well, if you could invest in volatility the same way how you invest in a stock or a company, right? You say, okay, I'm going to invest in Apple for the long run. If you could invest in volatility, it would be the greatest investment ever, because you know that, well, any vol will happen. It doesn't matter what market you're trading in, vol will happen, because it's just market dynamics and behavioral dynamics, right? But
Yeah.
the problem is you can't, because there's a cost, there's a risk premium that comes with that, right? So if you can invest in the VIX, it'd be the best thing ever, because you're like, I'm just gonna hold it, and then when it spikes, right, I could get out. But because that's not the way how the world works, if you have a product that is able to replicate something like that, where you're not losing money in the interim, you're not paying that premium in the interim, then it just becomes a function of, you know, hanging around until that vol event takes place, and that makes for a really good bet. And the analogy I like to use is, if you go to Vegas and let's say you play roulette, you're going to know that you don't have positive expected value playing roulette, right? Right. But if you go and let's say the manager says, hey, Darius, I like you a lot. So tonight, if you bet, red or black, doesn't matter, because guess what? We're going to cover 0 and 00 for you. Well, that means that if you hit on 0 or 00, you make a lot of money, but the money that you put down on there, you don't lose. We'll reimburse you. Well,
Yeah.
you're going to say, great, I'm going to bet red or black all night, because now I have positive expected value, right? Because now the 0 or 00 hits, I make a ton of money. If not, I don't lose any money. And then I could just bet red or black and go back and forth. So a little bit of a hyperbole in that analogy, right? But
No, it makes sense though.
yeah, but that's like what we're looking to accomplish as a whole, right? Is trying to deliver something that doesn't necessarily bleed out in a tremendous way that most of the vol products are known for.
Yeah, they really are, and I'll give you a couple slides here that I think you should share or find a way to kind of replicate for your own institutional meetings. One of the things that we have a tremendous amount of conviction on from a longer term perspective is that the current price of a long term U.S. government sovereign debt obligation is the wrong price. We don't know what the right price is. We have a view that it could possibly be 200 to 300 basis points higher in yield terms, but that's not to say that it has to get there overnight or has to get there in any real investable time horizon. And the reason we have that view is we did a big dive empirical study on forthcoming economic and financial market dynamics to sort of give ourselves a roadmap over the next kind of decade throughout the rest of this forthturning. And the conclusions were pretty stark. We're not going to give them all away here for free, but one of the two of the key takeaways were you should expect a significant upside surprise in the growth of the public debt relative to projections, and you should expect inflation to trend much higher. One, to spike, but also to trend much higher than it does, both relative to the prior business cycle, but also relative to the non-forthturning baseline. And so, we arrived at that conclusion specifically by looking at 200 years of data across a variety of economic and financial market metrics. We arrived at a similar conclusion a couple of years ago prior to doing that forthturning analysis vis-a-vis the lens of our secular inflation model. So, Colin, if you throw the slide up on the screen where we show our refreshed secular inflation model, this was refreshed for our yesterday's June 2024 macro scouting report. And what this model does is it interpolates the normalized change of the values of these key indicators that have all been proven empirically to be correlated or co-integrated with the underlying trend of core PCE inflation. And the key takeaway from this analysis, which we published in January of 2022, to tell investors, hey, this is not a transitory inflation spike. We're dealing with something that's more structural in terms of elevated inflation. Don't just kind of sell inflation and run. This is new. This is different. This is real. And the key takeaway from that analysis is that the underlying trend of core PC inflation, i.e. the horizontal line here that core PC inflation was oscillating around, was somewhere around 1.6%. Our model suggesting that the underlying trend is somewhere around 2.6% or even as high as 3%, based on, again, the normalized change in the coincident or leading indicators of core PCE. And so if we're tracking at 2.5 to 3% core PCE inflation, we're talking about an underlying trend of 3 to 3.5% headline CPI. And the reason that matters, specifically as it relates to volatility products and tail risk funds, is that bonds may not be this ballast of portfolio safety and this that it has been over the past kind of great moderation. I don't think I'm breaking news or breaking glass when I say that, but I think it's important to pull the time series back and do a deep dive study so that we can actually prove this quantitatively and have more confidence in that statement. When we go back and we look at the change in things, for example, the change in the stock price, stock market, and the change in the 10-year treasury yield, we find that the stock bond correlation is most negative, i.e., treasuries are a good hedge for your equity portfolio whenever inflation is in the 1 to 2% range, as it was in the prior decade. When you're talking about inflation being in the 2 to 3% range, or even in the 3 to 5% range, you're talking about positive correlations between stocks and bonds. Not extremely positive, but not negative anymore, not deeply negative as we were. We were coming out of a period where stocks and bonds were as deeply negatively correlated as they have been across 100 plus, 150 plus years of data. And so the key takeaway here is that if you're rocking with something that looks like a 60-40 portfolio, either as a retail or institutional investor, you must understand that, hey, you could have a lot more 2022 type experiences on a go-forward basis if our fourth turning analysis is right on where CPI is headed on a trend basis over the long term, and where the size of the government and size of the budget debt balance and budget and debt are headed over the long term. And if that's the case, if we have more 2022s, then investors are poorly positioned for that portfolio, because ultimately it means that they're going to have to rotate out of bonds being this balance of safety to things like volatility products, tail risk hedging, et cetera.
It's fascinating to hear you say that, man, because we're looking at the same thing from two different lenses, but ultimately coming up with the same type of conclusion. So I think the biggest thing that I have with some of the pensions and some of the larger foundations, which are huge institutions that move very slowly, right? So there's still investors like that believe in 60-40. The biggest thing that I have with them is that if you look historically at the more recent tail event crashes, you'll realize that bonds are not a correlation in tail crashes at all. At all. But like 2020 is a great example, right? Look what bonds did in March 2020. They got absolutely dismantled.
Totally.
So to think that, well, the deficit in the US is increasing, right? That is just increasing. And to think that, US govies will sit there and serve as a protection to equities, I think it's more so of a false perception based on data from the 70s and the 80s. And you have to understand that the equity market that we're in today is a very different environment than the 70s and the 80s. How many pension plans were allocated to equities in the 70s? Think about how many pension plans today. There's no pension plan that's not, like every pension plan is allocated, not only in the US, but you think foreign as well, right? So we talked to like a couple of foreign investors on like the Swedish side, and you think about all those flows that come from European investors directly into US equities. So when you look at the way how the equity market processes those type of flows and the way how it reacts to certain things, it's a bit falsified to look at that data from the 70s and think, well, okay, this correlation is going to act the exact same way, right? Different participants, different way the markets are functioning. So yeah, I think that's a really good point that you bring up, is that bonds are certainly not a hedge to not only some of the downside of market, but definitely not to the tail events. When the world looks scary. Sorry, go ahead.
No, I was going to say they're definitely not a hedge if the problem is inflation, right? I mean,
yeah.
We were exiting for on a trend basis where inflation was persistently below target and surprising to the downside throughout. This is a multi-decade period of time where bonds were the obvious winner in asset class terms from that perspective, in terms of the drivers of that asset class being the expected nominal rate and the nominal term premium. Colin, if you throw this slide up here on this chart where we show the Treasury term premium, this is the ACM model here that has term premium still negative as of today at -5 basis points on the 10-year. You can back up 150 basis points just to get to a mean level of term premium for the past, kind of 60, 70 years. And inflation expectations are neatly anchored somewhere around, let's call it 2.25 to 2.45%. And so if our model is even anywhere close to accurate, these numbers have to go higher, both term premium and inflation expectations over the long term. And so if we have a structural, kind of force that's taking yields on a nominal and real basis higher, obviously we're going to have economic fluctuations with growth and inflation that'll take yields up and down on a multi-quarter basis. But on a, kind of like a decade-long time horizon, you got to assume that the upward the all things being equal, the yield should gravitate higher over the long term. Now, that's what they should do. What they will do will obviously be a function of how the monetary policy makers decide to respond to that. We have a view that they're going to continue to bend the knee and kowtow to fiscal dominance and do what they have to do to make sure that this doesn't become a problem for the asset markets, the problem for the economy, and ultimately the problem for voters in this fourth-turning regime. But they're not going to do that on an ex-ante basis. They're not going to do that without being prompted either by the economy or asset markets to expand their balance sheets. So we're in for a wild ride from a structural standpoint in the bond market. In our opinion, there's going to be some significant and material fluctuations. But the key takeaway is from this analysis, in our opinion, is that you can't, as an investor, expect a 60-40 type portfolio to behave the same way that it does looking back at all the back tests. You have to just assume that from the time you've heard me say this, or the time you heard me say this 2 years ago when we started talking about 60-30-10, 18 months ago when we started talking about 60-30-10, you have to assume that this marks a new frontier. We are no longer in the old regime. This is a new regime where bonds and stocks are at best going to move in odd ways that are not consistent with the back test, and at worst, they can move in a positively correlated manner, which actually amplifies the risk in your portfolio in a drawdown.
Yeah, totally agree. I mean, same kind of applies for equity vol, right? Equity vol has been moving in a very, um, I'm not gonna say sporadic way, but when you think about the last decade of equity vol, the best example that I could give is, uh, it's becoming a monster on its own, and Feb 2018 of Volmageddon was a great example because if you ask people historically what they thought the VIX got to during Feb 2018 during Volmageddon, I think the average investor wouldn't know that it got to 50, right? And then I think if you ask that same investor, uh, how much did the S&P drop? I think they would say, well, VIX at 50, the S&P must have dropped maybe 10% in a week, 20% in a month. No, it dropped less than 5%.
Yeah.
Right. So you think about that. It's like these type of moves, a 5% drop in the S&P over the course of, let's call it 2 weeks or so, leading to a 50 VIX. That's quite extreme, right? Um, right. So the vol market is becoming its own monster, which we kind of look at as an opportunistic thing in terms of long volatility, because what you can have is this unraveling of the trade without any I'm gonna say without any massive decline in S&P. Now, the thing that drove it was the fear, right? That people were not able to understand what was taking place during that time, and we could get into the drivers of Volmageddon, how people messed up the rebalance on some of these ETP products and all that. But the point is that it just takes a small catalyst to get people riled up that could really drive equity vol. And when those market participants move out, you could see equity vol soar and decouple away from what the traditional correlations in terms of how people view S&P and vol. And I also think it's sort of one thing that we're seeing today too, but on the other side. And like I just want to take a second to explain this. So um, when you think about the vol environment today, people will say, well, why is it that vol is so low? I think vol should be higher, right? And it's because the what's going on is what we like to call dealer hot potato. And this dealer hot potato is when you have the end user coming in to sell volatility. The dealer is effectively long volatility and long gamma.
Mhm.
Being the dealer, right, the market maker, it's not in your interest to take directional risk, right? So what you want to do with that is get that off, right? Get that off, collect some type of spread and get it off. But what's happening is when vol goes up, the end user community, like all the short volatility things we spoke about, will come in, they'll sell vol. Now the dealer is long vol, and they're just trying to play hot potato to pass it around. And reflexively, what that does is it drives the price of vol lower and lower, which is why in today's environment, you're seeing things like VIX going to 20, and then you turn your head, and in 5 days, 5 trading days, it's moved 7 or 8 vol points lower to 12.
Mm.
Historically, what if you go through the data, what you'll realize is that that really wasn't the case. Historically, when VIX spiked up at the certain levels, it found a little bit of a ground. Maybe VIX went to 20, and then it would, move 4 vol points lower to 16 and stay there. But this real overreactiveness in both directions, where vol's going up and then immediately gives that back, caves that back. It's because of that dealer hot potato that's going on. So to kind of go back to my initial point, is that that vol environment is changing, and it's decoupling away from the way how most vol traders and market participants used to think about vol, and just vol in that sense. So our view is that the same way how it could decouple to the downside when short volatility is going well is the same way how it could decouple to the upside, right? When you've seen those moments of extremity, they could reflexively drive much higher than people are traditionally used to thinking.
Yeah, no, I mean, we seem to be living in an era of extremes, and that's kind of part and parcel with the forward turning. We have a lot of internal social and socioeconomic kind of struggle that's only going to get more intense as we move forward in time. And so those types of market dynamics, which we forget, markets are a collection of individual behaviors and decisions. And those types of extreme market dynamics are something that you should probably brace for and anticipate on a longer term time horizon. I'd like to transition to some questions here. We have a couple questions in the queue here, but I'll start with a question of my own, which is, what's your highest conviction view, either a trading view or an economic view, or just whatever you have the most conviction in over the short term, and then follow that up with what's your highest conviction view over the long term?
I wish you would have asked me this question like 6 months ago, because I wish I was on record. The only people that could validate this is my business partners and guys on the desk. But I've definitely been, again, our trading has nothing to. I mean, our trading has nothing to do with my macro takes or my views like this. Our trading is process driven, but uh, as a team, you like to take those things in terms of like, yeah, you think the market's going up or down. So if you'd asked me this a few months ago, I actually thought the market would be at all-time highs. So I'm patting myself in the back a little bit, but only my partners can validate, because I don't think I publicly said that anywhere. So that sucks. But
Right.
today, today, I'm not too sure. In terms of, where we have the most conviction. Like from a macro standpoint, the number one thing that we have our eyes on is really the exposure and the growth of that short volatility trade. And in our last investment letter at the beginning of the year, we wrote that we give it a 12 to 18 month horizon, right? So we're roughly about the 12-month mark where we think that that trade will unwind eventually within the next 12 months. So that's something that I think we have a lot of conviction on, is just where the positioning is right now. It won't take much to get that trade to, vol to really blow out. So that's one thing. In the short term, I do think that election time always makes for an interesting vol trading environment. That's not necessarily in line with saying that there's a tail event coming in the election time, but I just think that if you look at the curve and you think of a 17 VIX around a time where you have two polarized candidates within their both crazy respect, I think that the vol market will move a little bit more than that. All right, so maybe that means 25 to 30 VIX or something like that. But I do think that 17 VIX for this type of election is a bit underpriced, personally speaking. Um, but who knows? Not much conviction on that side, but I guess the biggest conviction is just in the fact that we think that the short vol trade is sort of moving towards the end of its cycle.
Yeah, it's hard to know what, if you're, bottom of the ninth, 2 outs, 3-2, but you can know that you're probably in the bottom third of innings, right? You don't know if you're top of the seventh or bottom of the ninth, but you're in the bottom third or top third of the inning. So I like the way you kind of phrase that with the appropriate amount of humility and process. And speaking of process, I know I keep delaying the questions here, but you said something that really warms my heart. And it's something that, is very part and parcel to our research and risk management process, but also to the research and risk management processes that, I've seen and learned from across, with my dealings in the global buy side for the past 15, 16 years. And that is our trading, my research views do not impact our trading. And I don't know how profound the average investor, when they hear something like that, I don't know if they realize how profound that is, because it's very different than how average to below average investors invest. Average to below average investors, of course, there's a full distribution of investors. Colin, you can get those slide on the screen. There's obviously a full distribution of investors. So I don't mean to offend anyone, but obviously if you have a distribution, you're going to have a max, min, median, average, standard deviation, and all that. And so when you focus on the lower median of investors, or the average to below average investors, what they're generally doing is, I think something is going to happen, therefore I put position XYZ on. And when they change their mind on what they think is going to happen, or it turns out to be wrong in most cases, because most people suck at predicting the future, including institutional investors, then they change their position. And the reality is, in our opinion, we think that is a less optimal way to invest. It's not a bad way to invest. It's a better way to invest than probably flipping a coin or slipping on a banana. But there's a better way to invest, in our opinion, and that is, going back to what we talked about with the momentum that we've observed in asset markets. In our opinion, the best way we've figured out the best way to invest, based on our technical expertise, is helping investors identify and position for the market regime. We're very similar to what you guys are doing in Ambrus Group here at 42 Macro, in the sense that, we have tens of thousands of eyeballs on me daily, and I think I do a pretty good job of predicting what's going to happen in the economy, more than most. Again, I don't think my predictions of what's going to happen in the economy are, have any accuracy that's worthy of putting a position on for, because I don't think most people's predictions of what's going to happen in the future is worthy of. What we're trying to do is help you identify and position for the market regime. And then we use our fundamental research process and our macro weather model to help investors kind of get a general sense of the full distribution of probable economic outcomes, so that when regime change happens, they have confidence to do something differently. And I kind of wrap up with this final slide, where we show our market regime back test for stocks. And so what we find is that, when you're in a risk on market regime, which is Goldilocks and inflation, you have 83% of the S&P 500's cumulative performance since January of 1998 has come in a risk on market regime. So newsflash, if you're in a risk on market regime, be long stocks or be long risk assets. And only 17% has come in a risk off market regime. And you can see, obviously, the Sharpe ratios are obviously quite disparate. That dispersion in performance between risk on market regimes and risk off market regimes, which again, drawing the line between Goldilocks and reflation, which is the risk on regimes, and inflation and deflation, which are the risk off regimes, that dispersion of performance is even more extreme in the crypto market. 109% of the cumulative performance we've seen in Bitcoin has come in a risk on market regime, versus minus 9% since the advent of the asset class. And as you can see, the Sharpe ratios are incredibly disparate as well. And so the key takeaway here is to do as the market regime tells you to do, which is why our discretionary risk management overlay, which is the main tool we use to communicate to investors what they should be doing in asset markets. That's why the market regime is the dominant driver of that, as well as our volatility adjusted momentum signal, in terms of recommending what they should be doing in proper trade terms. So for example, we've been in this risk on market regime condition since going back to November of last year. And, as a function of that, and the S&P 500 being bullish, it's recommended a long max position. And that's been the case for going on 6-7 months now. And so the key takeaway is, you don't have to predict the future to make a lot of money in asset markets. You don't have to predict the future to protect gains and save a lot of money in asset markets. You just need to wake up and do your job and observe inflections and or persistency in momentum. And it's our job as investors, institutional investors, to understand, okay, when there is an inflection in momentum that we need to respond to with changes in our portfolio, then we understand the full distribution of probable economic outcomes so that we can act with confidence. Right? If I just told you tomorrow we're in a risk off market regime, you're going to go, okay, where'd that come from? Okay, how long are we going to be in the risk off market regime? But we just put out our June macro scouting report. Every month we put out a slide deck that's around 125 plus slides, where we help investors understand everything that's happening with growth, everything that's happening with inflation, everything that's happening with policy, everything that's happening with liquidity, with the positioning cycle, et cetera, so that when market regime switches and or any of these signal switches here in proper trade terms, you have the confidence to do something to respond to that signal in your portfolio, as opposed to fighting it, which causes you to lose money. So sorry for that, kind of diatribe, but I'm so glad you said what you said, because I find myself, I feel like I'm talking to a ghost sometimes. But even just today, I was listening to Howard Marks' a podcast with Nikolai Tangen in Good Company. I'm sure you're familiar with that podcast. Nikolai's the CEO of Norway's sovereign wealth fund. And so obviously he's plugged in with all these high-end institutional investors. And so he has these weekly conversations with them. And Howard Marks' conversation today sounds just like you and I talking. Hey, man, we're not here to predict the future. We are trying to predict the future, but it's not impacting our positions. What impacts our positions are changes in signal. And that if investors take away one thing from me today in this discussion, that it should be that.
Yeah, definitely. I mean, like when I first got onto the desk as a prop trader, that was drilled into my head a lot, was that the way how you think about trading is that you look at the environment, you figure out a certain edge, or think of a certain edge, right? Then you go and you statistically affirm that, right? So now you have to go and quantify that edge, right? So let's say, I'm just making this up. Let's say I believe that every day at 9:46 a.m. I think the S&P goes 10 basis points lower on a Wednesday, or sorry, like on a Wednesday. I'm just making this up, guys. Don't go and test this, right? Well, if I've observed that, now I have to go statistically affirm it. And if I could affirm it, right, then now the next step comes with thinking about, how do I take advantage of that? How do I harvest that? Do I buy puts? Do I short it? Right? What's the most optimal way? And then from that point, you build risk controls around it, and then it's about being disciplined. So then ultimately your job turns into a function of waiting for that signal to go off, right? And being disciplined around following the signal and being disciplined around the risk controls, as opposed to waking up and saying, yeah, I think the S&P is going down today, right? Based on what, maybe some comment that the Fed said, maybe on something that you read, right? That's not really the best way to go about it. So I couldn't agree more with what you said, thinking about the world from a macro standpoint and still following those signals. And even when it comes to, proprietary trading and trading, intraday edges, it's sort of the same principles.
Awesome, man. Well, you've been super generous with your time, so we'll keep it tight with questions. We just have one here. So from our friend Jimmy. Says, hi, Jimmy. Says, hi, Chris. Have you analyzed any of the newer tail risk ETFs, like Simplified's tail risk, Cambria's tail risk ETFs? What is your opinion of these? Do you think they provide adequate tail protection for retail investors?
Yeah, so I think those guys that are at Simplify and Cambria are good guys, and they make really good products, right? So I just want to start out by saying this, because I I know that when you think about the ETF landscape today, it's amazing compared to 15 years ago, right? 15 years
Amazing
ago.
compared to 5 years ago.
Yeah, no, exactly. Right. Like if you wanted exposure on Korean bonds or something like this, 10 years ago, you had no idea where to go or what to do, right? But then now you could look up there's maybe some ETF that does that, right? So I think the product development has been fascinating. I am biased, right? And I will say that I don't think that um, ETFs can make for good tail products, because the majority of ETFs, the process is very dogmatic. And when doing something that's tail orientated, it's outside of the distribution, right? So you're trying to quantify something that is pretty much unquantifiable, right? So if you, it's the same type of approach. If you say, all right, I'm going to buy a 5 delta S&P put every 3 weeks and then roll it, and if you run a back test on that, and what you'll realize is that it's terrible, right? So personally speaking, I just think that ETFs, tail risk hedging is probably the most difficult thing to package in an ETF, which is no knock on the ETF issuers or anything, but I just think that it's a very, very challenging thing to do in an ETF basket. So that's kind of my take there.
Well, cool, man. I appreciate that. Well, thanks again for your time and all your insights, man. I love connecting with you. It's fun to see another young Black man in this industry shine and do his thing. Another of someone who fears God like myself, and it's awesome to just you watch you guys thrive and do great work for your clients over at Ambrus Group. Again, Kris Sidial, definitely check him out on Twitter. And again, as I mentioned earlier, look up those Ambrus white papers and then inquire if tail risk hedging is something that you're thinking about putting in your portfolio. Hopefully, we made a good case for that today, even though both of us are still kind of sanguine on markets here over the medium term. So, any final parting thoughts, my friend?
Uh, I don't know if I have any any like big takeaways in terms of giving the listeners, but I just want to say thanks for having me on, man. The feelings are mutual. Really appreciate everything that you do. I love reading the research stuff, and yeah, hopefully we could do it again soon.
Awesome, brother. I appreciate you, man. God bless you, brother.
Same to you, bro.
Cheers.
All right.